Spotting undervalued stocks isn't the cup of tea of newbie investors. Though on the other hand, if taught right, it can easily pull off 40 to 50% returns without any doubt. For people who desire to open the door to a financially strong future, the stock market can be the key to that door if you follow the correct instructions and plan for long-term strategies, holding the rope of patience real tight. Which is also why we've made this video. Today we'll consider a top-secret checklist which you can use to easily determine undervalued stocks, and additionally, we'll also have a look at a few undervalued stocks of the current date. You'll find a few timestamps on the screen. Feel free to hop right into the main part if you'd like to. So get yourself prepared to pick and make sure you stick tight, as this is going to be really helpful. Picking or investing in undervalued stocks falls under the category of value investing, to be more specific. Many veteran investors all around the globe, including Warren Buffett, follow the footprints of picking undervalued stocks and consider it as a fundamental part of their investing checklist. That being said, you should never consider value investing or investing in general as something only limited to pro and experienced investors. Let's hear a quote on it, according to Mr. Warren Buffett. "You don't have to be a rocket scientist. Investing is not a game where a person with 160 IQ beats the guy with 130 IQ. That being said, let's get into the main talk. I've specifically tailored a quick checklist that will massively help you filter out overvalued stocks so you're only left with undervalued stocks to choose from. The point I'm about to discuss will not only help you set standards before you put your hands over a stock, but it will also be greatly helpful if you're only planning to gain some technical analysis-related knowledge from it. So without further ado, let's dive into it. Number 1. Financial metrics. One of many ways to identify potentially undervalued sectors is to compare the financial metrics of different sectors. Analyzing the PE ratio of a stock is one of them. According to Investopedia.com, the ideal PE ratio level is around 15 to 20. Anything lower than that is great too, but that also indicates that there's something wrong with the company. So make sure to give the last 2 to 5 years net profit margin and earnings per share of the stock a view, and avoid the company if there's anything negative reported. For example, Hinduja Global Solutions, a leading IT services outsourcing business with a PE ratio of 1.16, 5-year average net profit margin of 17.5%, 5-year EPS growth of 104%. From a financial perspective, Hinduja Global Solutions represents a decent value for money for its investors. Number 2. Market trends. Another great way of picking undervalued stocks is by analyzing growing sectors and then finding directly linked stocks with it. An example would be the 2022 Union Budget. On the 1st of February of 2022, around 48 billion rupees worth of subsidies was granted specifically for the farmers and agricultural industry. And within a month of that, we directly saw a spike in the agricultural sector of the stock market. Similarly, picking fertilizer producing companies, as they are directly tied up with the agricultural industry, would be a smart decision to make as well. Number 3. Growth prospects of the stock. This means evaluating the company's potential to grow and create value for shareholders over the long term. There are several factors that can impact a company's growth prospects, including the demand for its products or services, its current market share, and the company's competitive advantage. The points I've just shared will help us determine the intrinsic value of the stock, or in other words, it will indirectly answer the most awaited questions like, is the stock even worth it? What is the guarantee of my profits? As Warren Buffett once said, investing should be more like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. So the summary of this checklist is that you only buy stocks that are not only cheap but also worth the value. Golden tip: look out for dividend-paying stocks. Finding undervalued stocks that also pay dividends is like finding gold from the dirt. A high dividend yield is a technique used by many companies in the past to boost their stock value and attract more investors. However, on the other side, companies like ITC Limited, which is the largest tobacco manufacturer in India, are not permitted to advertise their products to sell more tobacco, which is why they pay out dividends to soar up their stock value and attract more investors into buying their stock. This is why you might find it a bit more difficult than usual to find undervalued stocks that also pay dividends to their shareholders, but I'm sure you won't walk out of the market empty-handed. Having a margin of safety. Similar to how you leave early to catch a flight, you should keep some buffer for errors in your investments as well. I'll share a really helpful formula, which Ben Graham has mentioned many times in his top-selling books. That is, intrinsic value equals earnings per share multiplied by 8.5 added to twice the expected annual growth rate. Now, you might use this to estimate the intrinsic value of the particular stock, but the point of thought is that you must not invest at a price that is not significantly far from the intrinsic value. Or in other words, you should keep a small margin of error to lighten up your risks associated with investing. For example, the average growth rate for HDFC Bank is around 18%. By this formula, its intrinsic value will be about 2970 at an EPS of 66.8 rupees for 2022. The current price is 1630, which indicates a 45% undervalued nature. So an investor is safe buying such investment trading way below its fair price. That being said, I've compiled a few stocks so we can actually implement what we have learned. Here are a few undervalued stocks in the Indian stock market. Number 1. Power Finance Corporation Limited. Founded in 1986, Power Finance Corporation Limited is a non-banking financial company engaged in the business of financing companies. The company has a market cap of 38,162 crore rupees. The stock's 5-year historical EPS growth is 44.35%. Its PE ratio is 2.72. Number 2. Oil India Limited. Founded in 1889, Oil India Limited is a fully integrated exploration and production company in the upstream sector. The company is the second largest Indian government-owned hydrocarbon explorer and producer. Its market cap is equal to 22,658 crore rupees, and its 5-year historical EPS growth is 31.31%. The company's PE ratio is 4.03. Number 3. GlaxoSmithKline Pharmaceuticals Limited. Founded in 1924, GlaxoSmithKline Pharmaceuticals Limited is one of the oldest pharmaceutical companies. The company's portfolio includes prescription medicines and vaccines. The company has a market cap of 22,602 crore rupees and a 5-year historical EPS growth of 38.15%. Its PE ratio is 13.34%. And number 4, Sanofi India Limited. Founded in 1956, Sanofi India Limited is one of the world's leading pharmaceutical companies. The company develops medicines in therapeutic areas such as cardiovascular disease, thrombotic diseases, metabolic disorders, oncology, and more. The company has a market cap of 13,181 crore rupees and a 5-year historical EPS growth of 25.43%. Its PE ratio is 13.96. These were a few stocks which I've personally picked and chosen for you guys. Still, doing your own research is a must-do before considering to invest. Though apart from all the technical analysis, here's a quote by Mr. Warren Buffett which will help you to get a non-technical aspect of it. Let's hear the quote. If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. That being said, let's dive straight into the realm of compound and let's see how basic compounding can exponentially multiply your investments in no time. Undervalued stock picking paired with compounding. As a newbie investor, you might find it difficult to digest. How are certain investors able to make crores worth of wealth through the stock market? Is it really possible to make billions from the market? Well, the answer lies deep within the secret of understanding how compounding works. To simplify the understanding of compounding, there's a simple rule of thumb called the Rule of 72. This means taking whatever returns you expect to get and divide 72 using that. The resultant number would be the number of years it would take to double your initial input. Through the power of compounding, a small amount of money can grow into a substantial sum over a period. The longer the time frame, the greater the value. This was all for today's video. To guide you on buying undervalued stocks, make sure to keep subscribed, and before leaving, let us know in the comment section in which stocks are you planning to invest. We've also uploaded a video on the book The Psychology of Money on our channel. Make sure to give it a view as well. Till then, Omega Finance signing out.